Think about investing. You continue to invest money and receive poor returns. Legitimately? Here are some investment lessons by Warren Buffett. A list of 10 mistakes that other investors make, but first let's get to know a bit about Warren Buffett. Welcome to Finance Explained. Warren Buffett, or Warren Edward Buffett, is an American businessman and philanthropist born on August 30, 1930 in Omaha, Nebraska. He is widely regarded as the most successful investor of the 20th and early 21st centuries, having defied prevailing investment trends to amass a personal fortune of more than $100 billion. Buffett, also referred to as the Oracle of Omaha, was the son of Nebraska U.S. Representative Howard Homan Buffett. He earned his B.S. from the University of Nebraska in 1950 and his M.S. from the Columbia University School of Business, where he studied under Benjamin Graham. In 1965, Buffett acquired majority ownership of a textile company, Berkshire Hathaway Incorporated, making it his main investment vehicle. Buffett moved back to Omaha in 1956. The major stock indices soared by around 11% yearly from the 1960s to the 1990s, but Berkshire Hathaway's publicly listed shares increased by nearly 28% annually. Buffett was among the world's wealthiest people thanks to his success with Berkshire Hathaway, yet he avoided extravagant spending and opposed laws and taxes that favored the wealthy over the poor. Here are some of the investment lessons he learned along the way. Purchase of Berkshire Hathaway. Warren Buffett claimed that Berkshire Hathaway was the worst investment he had purchased in a 2010 interview with Becky Quick on CNBC. Buffett made his first investment in Berkshire Hathaway in 1962 when it was still a struggling textile business. He bought much of the stock because he believed he would profit when other mills shuttered. Later, the company attempted to cheat Buffett out of additional funds. Buffett, who had been enraged, had taken over the business, sacked the manager, and attempted to save the textile industry for another 20 years. According to Buffett, this retaliatory action cost him $200 billion. Wambach Textile Company acquisition. Buffett regretted buying the failing textile company Berkshire Hathaway in 1962, but he repeated the mistake when he bought Wambach Mills, another New England textile firm, 13 years later. According to the assets we obtained and the anticipated synergies with Berkshire's current textile company, the purchase price was a bargain, Buffett stated in his 2014 shareholders letter. Buffett said that he had made a catastrophic error in buying Wambach, as the mill had to be shut down not long after Berkshire had bought it in 1975. The most important takeaway from Buffett's terrible Wambach investment is to learn from your mistakes. If you don't succeed the first time when investing, try a different approach. Purchasing Tesco stock. At the end of 2012, Berkshire Hathaway held 415 million shares of Tesco, a retailer based in the United Kingdom. While still substantially invested, the company sold some equity. The grocery store overestimated its profits in 2014 and its shares fell. Buffett said that worries about Tesco management were the driving force for his original sale of stock, which generated a $43 million profit in the 2014 letter to shareholders. Sadly, he took his time with the remainder of it. I'm ashamed to say that a careful investor would have sold Tesco's shares earlier. By dragging my feet with this investment, I made a tremendous mistake, Buffett stated. He acknowledged that the decision caused the business to lose $444 million after taxes. Making decisions quickly is the lesson to be learned from this episode in Warren Buffett history. Using Berkshire stock to buy Dexter Shoe Company. Warren Buffett didn't hold back with his regrets over buying Dexter Shoe Company, but in his 2014 letter to shareholders, he expressed frustration over how he paid the $433 million purchase price. Rather than giving the sellers cash, he used Berkshire shares to fund the purchase. When he wrote the letter, he revealed that those shares were valued at $5.7 billion. As a financial disaster, this one deserves a spot in the Guinness Book of World Records. You're probably not buying and selling million-dollar companies, but you can learn from Buffett's mistake by ensuring your resources are properly allocated. If your current portfolio is performing well, don't pull money from solid investments to take a chance on a wild card. Borrowing money from your assets of energy futures. Buffett addressed the issues with energy future holdings in a 2013 letter to shareholders. The equity owners contributed $8 billion and took out further loans. Buffett remarked, "About $2 billion of the debt was purchased by Berkshire, pursuant to a decision I made without consulting Charlie," alluding to Vice Chairman of Berkshire Hathaway, Charles Munger. Buffett accurately foresaw Energy Future Holdings' bankruptcy filing. He claimed that although Berkshire Hathaway lost $873 million before taxes, it nevertheless sold its interest in 2013 for $259 million. The takeaway from this Warren Buffett loss is to never go into a major choice without first consulting a reliable business partner or confidant. This market is strange. Every time one guy sells, another buys, and they both believe themselves to be intelligent. Let us know in the comments below what you think about this. If you're enjoying the video so far, be sure to like and subscribe to our channel to see more such content. Moving on. Not purchasing the NBC station in Dallas-Fort Worth. Not all of Warren Buffett's recommendations are the result of losses. One of his regrets is not spending the $35 million to purchase the Dallas-Fort Worth NBC station. Buffett said that he passed up the opportunity to buy the station when he bought See's Candy in 1972 in his 2007 letter to shareholders. Even though he had complete faith in the person who made the offer and was aware of its excellent growth potential and near zero capital input requirements, he declined it. Buffett reflected on the lost chance and noted that the station made $73 million before taxes in 2006 and was worth $800 million at the time he sent the letter. The story's lesson is to profit from opportunities. Not doing enough research before purchasing General Reinsurance. The purchase of General Reinsurance by Warren Buffett provides numerous investment advice. He provided more details about why Berkshire Hathaway suffered such a significant initial loss on the acquisition in his 2001 shareholders letter. This included suffering underwriting losses, neglecting to consider the likelihood of terrorist attacks, and missing the fact that Gen Re lacked sufficient reserves to cover losses from previous policies. In 2001, Berkshire Hathaway suffered losses of $800 million because of the latter. The key takeaway from this example is to verify the figures and run them past several reliable consultants. You should always be aware of your potential worst-case financial exposure. Failing to research Lubrizol Corp stock thoroughly. In 2011, Warren Buffett and Berkshire Hathaway came under fire after discovering that David Sokol, the chairman of several companies at the time, had approached Buffett about acquiring Lubrizol Corp. The issue was Sokol's ownership of stock in the chemicals firm. For almost $9 billion, Berkshire acquired Lubrizol, and Sokol made a $3 million profit. He broke insider trading laws by failing to disclose to Buffett that he owned company shares. Buffett didn't immediately recognize his error, but he acknowledged it at the 2011 Berkshire Hathaway annual meeting. He said he should have questioned Sokol more thoroughly. The best investment advice in this situation is to exercise moderate trust. Ask more questions than you initially believe are necessary. Refusing to purchase Amazon stock. Buffett was questioned about why he had never purchased Amazon stock during a Squawk Box appearance in February 2017. He acknowledged that he was at a loss for words. He remarked, "Obviously, I should have purchased it long ago, as I adored it long ago. But as I moved along, I was unable to grasp the model's potential. Additionally, the pricing always seemed to be a better reflection of the model's strength at the time. It's one I really missed then." The fact that Warren Buffett never invests in companies he doesn't fully comprehend is both a plus and a minus. Blindly supporting businesses is not a good idea, but staying away from them is also not a reasonable choice. Having a partner whose talents are different from yours can help. Buying US Airways shares. Warren Buffett regrets his 1989 acquisition of $358 million worth of shares in US Airways, even though it didn't make the list of his unsuccessful investments. Buffett most likely received all his investment and dividends back, according to Forbes, despite the fact that the shares never increased in value during the turbulence. Buffett attributed the airline's recovery to the departure of both him and Munger from the board, as well as the hiring of CEO Stephen Wolf. He commended the latter for avoiding what may have been an expensive expenditure. The lesson here is, whether you're a novice investor or an experienced pro, to always do your research before investing so you know precisely what you're getting into. It seems we've reached the end of this video while learning a few of the investment lessons that Warren Buffett has learned over the course of his career. Even if he has some investing regrets, he nevertheless succeeded in life. If you enjoyed today's video, please hit the like button, subscribe to our channel, and share it with your loved ones so that they may learn some investment advice. See you in the next one. Bye!